Welcome to today's stock analysis, where we will analyze two interesting stocks in the pharmaceutical industry. These companies are Sanofi and Johnson & Johnson. Our focus is on assessing their intrinsic valuations using 5 distinct models. By employing these analytical methods, we aim to uncover potential investment opportunities and identify compelling valuations. Let's dive into the intricate world of stock analysis and discover what these insights reveal about today's stocks. Now, we've seamlessly integrated the ticker symbols for Sanofi and Johnson & Johnson into our spreadsheet, automatically importing the relevant stock data. Examining the 365-day graph, we observe a fluctuating flat trajectory in both stock prices over the past year. Sanofi has gained by approximately 2%, while Johnson & Johnson has shown an increase of close to 4%. Shifting our focus to valuations in comparison to target prices, Sanofi appears to be approximately 16% below the mean analyst target price, signifying potential undervaluation. Conversely, J&J aligns more closely with its analyst target price with only a 8% difference. Both stocks exhibit an RSI around 50 to 60, indicating a balanced state with neither being oversold nor overbought. Now, let's delve into a more detailed analysis of the intrinsic values for these two stocks, utilizing the 5 distinct intrinsic valuation models embedded in this spreadsheet. This exploration will provide a comprehensive understanding of Sanofi and J&J's intrinsic valuations. Our initial stop in the realm of intrinsic valuation brings us to Graham's revised valuation model, a creation of the legendary Benjamin Graham. This model enables us to determine intrinsic value based on 3 key inputs: earnings per share, the anticipated growth of the company, and the current yield of a AAA bond. Fortunately, our automated spreadsheet streamlines the process, requiring only the addition of the company's projected growth, readily available on platforms like Yahoo Finance. Upon incorporating the projected growth for Sanofi into this model, the intrinsic value calculation yields $30.33. Remarkably, this indicates that Sanofi's intrinsic value is approximately 38% below its current stock price. Applying the same methodology to Johnson & Johnson, the intrinsic value computation results is only $54.97, revealing a substantial difference of 66% relative to the current stock price. Moving on to the next valuation model, we explore the Peter Lynch dividend-adjusted fair value model. In this method, the Peter Lynch fair value is determined by adding the earnings growth rate and the dividend yield, and then dividing the result by the price-to-earnings ratio. The output is a value either above or below 1, where a value below 1 suggests an overvalued stock, while a value above 1 implies an undervalued stock. Upon applying this model to Sanofi and J&J, both stocks exhibit a Peter Lynch fair value below 1, indicating that they are currently overvalued. To refine this assessment, we perform additional calculations, although I won't delve into the specifics in this video to derive a more tangible fair stock price. For Sanofi, this computation yields a fair stock price of $26.35, falling below its current stock price. Similarly, Johnson & Johnson's fair stock price is calculated at $39.73, once again coming in lower than its current stock price. Now, let's delve into the comparable company analysis, also known as the multiples valuation model. This approach involves identifying companies similar to the one under scrutiny and utilizing their price-to-earnings ratios to calculate intrinsic value by multiplying with the company's earnings per share. In our analysis, I've included comparable companies for both Sanofi and Johnson & Johnson. Focusing on Sanofi, the intrinsic value derived from this model stands at $71.78, almost 50% above the current stock price. Shifting our attention to Johnson & Johnson, the calculated intrinsic value is $146.90, slightly below its current stock price. This comparison unveils interesting dynamics, suggesting that Sanofi is currently trading at a valuation under its industry peers, while Johnson & Johnson might be experiencing a slight overvaluation. Now, let's explore the dividend discount model, a method that delves into a company's dividend payouts over recent years. We calculate an average dividend growth rate, and this, along with the discount rate, is used to determine the intrinsic value of the stock. The spreadsheet also offers the flexibility to input a custom dividend growth rate, allowing for adjustments to be more conservative, if desired. Both Sanofi and Johnson & Johnson pay out yearly dividends, which allows us to use this model on the two stocks. For Sanofi, a company with consistent dividend payouts, we leverage the yearly dividend information available on Yahoo Finance. By incorporating the total yearly payouts and setting the payout interval to yearly, we obtain an average dividend growth rate of only 0.66%. Utilizing a discount rate of 8%, the calculated intrinsic value for Sanofi comes in at $26.11 due to the very low dividend growth. Notably, this intrinsic value falls beneath the current stock price. Johnson & Johnson pays quarterly dividends, and when we add the quarterly payout for each year to the table, we obtain an average dividend growth rate of 5.57%. Utilizing a discount rate of 8%, the calculated intrinsic value for Johnson & Johnson comes in at $223.42. This intrinsic value is above the current stock price, signaling a potential undervaluation of the stock using this model. Our final stop on this intrinsic value journey brings us to the discounted cash flow model. This model values a stock by estimating its future free cash flows, discounting them to present value using a chosen discount rate. It then factors in total debt, adds cash and cash equivalents, and divides the result by shares outstanding to determine the intrinsic stock value per share. For Sanofi, we can source the necessary data from Yahoo Finance, including cash and cash equivalents, total debt, shares outstanding, and free cash flow data available online. When we integrate this data into the model, the intrinsic value calculated stands at $70. Remarkably, this is 43% over the current stock price. On the other hand, applying the same methodology to Johnson & Johnson, the model yields an intrinsic value of $163, which is in line with the current stock price. These diverse intrinsic valuation models provide us with a comprehensive perspective on the intrinsic values of Sanofi and Johnson & Johnson, offering valuable insights for investors seeking a deeper understanding of these stocks in the market. And the summary section, we've assessed and compiled all calculated intrinsic values for Sanofi and Johnson & Johnson, making strategic decisions on which valuation models to include in the final calculation. Using the average intrinsic value for all 5 models, the mean intrinsic value for Sanofi is $44.89, which is in line with the current stock price. Acknowledging the inherent uncertainties, a margin of safety of 20% is incorporated, leading to an acceptable stock price of $35.91, below the current stock price. In the case of Johnson & Johnson, the decision to exclude the Peter Lynch dividend-adjusted fair value, considered an outlier, refines the intrinsic value to $147.12. By applying a margin of safety, the final acceptable buying price hovers at $117.69, significantly below the current stock price. In conclusion, neither stock presents a clear-cut attractive buying opportunity. However, according to the calculations, Sanofi emerges as the more favorable option, considering that the difference between the current stock price and the calculated intrinsic value is the smallest. Closing this video, I'd like to highlight that the intrinsic valuation tool featured in this analysis is available on my Patreon page, along with other tools designed for stock analysis and portfolio tracking. For your convenience, you can find the link to the page in the video description below. Now, a crucial disclaimer: I am not a professional financial advisor. The stock analysis presented on this YouTube channel is intended for informational purposes only and should not be construed as financial advice or a recommendation to buy or sell any stocks. Always conduct your own due diligence and seek professional advice before making any investment decisions.